Welcome to the Deep Dive, where we try to cut through the noise, get straight to the insights. Today, we are plunging into, well, a pretty fascinating transformation story right at the heart of the AI revolution. We're talking about Nebius Group NV, ticker symbol NBIS, a company making some serious waves, in high-performance computing.
Yeah, and look, this isn't just another tech launch. Not at all. Nebius Group's emergence back in July 2024, that wasn't just some corporate reshuffle. It was really a strategic rebirth. This company, it was basically forged out of necessity, the divestment of Yandex N.V.'s Russian assets, right? A direct result of international sanctions. So what we're seeing now is Nebius finding its feet, establishing itself as a newly focused, pure-play AI infrastructure company. And its independent public journey really kicked off when shares resumed trading on NASDAQ in October 2024.
Okay, yeah. Let's unpack this then. Our mission for this deep dive, really, is to explore their financials, look at the company structure, and understand the market dynamics, because that's what positions Nebius as this, well, high-growth, high-risk proposition, especially with the demand for AI compute just exploding. It's a story of, I guess, audacious ambition, unprecedented opportunity. And we're going to tell you why it matters. So, peeling back the layers on Nebius, you find this interesting paradox, right? How does a brand new company, an independent entity, just hit the ground running with what feels like decades of experience already baked in?
It really is a unique origin story. This strategic separation from Yandex N.V. in July 24, like we said, directly because of sanctions. But here's the crucial bit. Nebius didn't just get assets, it kept key management, a really highly skilled team. We're talking Yandex's co-founder, Arkady Veloz, who's the current CEO. And it's not just a handful of people, it's about 850 top-tier AI engineers. So yeah, they get to act like a startup, agile and fast, but with this deep institutional knowledge, this raw talent from an established tech giant. They weren't starting from zero on people.
Right, that's a huge head start. So beyond the talent pool, what are they actually doing? What's the product? Is it just, selling raw compute power? Or is Nebius building something more complete?
Oh, it's far more than just bare metal GPUs. The flagship is Nebius.AI. That's the central pillar. Think of it as an AI-centric cloud platform specifically designed for really intensive AI workloads. It's comprehensive full-stack infrastructure. So everything from massive GPU clusters, the cloud services, right down to specialized developer tools you need for AI models. And crucially, they are all in on advanced NVIDIA GPUs, actively using the H100s, the H200 Tensor Core GPUs. And here's where it gets really, really interesting. Nebius expects to be among the first to get NVIDIA's next-gen Blackwell platform. They're planning to deploy over 22,000 of these NVIDIA Blackwell GPUs in the US and Finland in 2025.
Wow. Early access to that kind of tech.
Yeah.
That's a massive competitive edge. So it's clearly not just the core platform. They're thinking bigger picture. How are they building out a broader ecosystem? Any other strategic ventures?
Yeah, they've got a few key subsidiaries, pieces that sort of complete their AI ecosystem picture. First, there's Toloka AI. Think of them as a vital data partner for generative AI. They focus on training and fine-tuning models, which is, super critical. Then you have TripleTen. That's an ed tech platform. It's dedicated to reskilling people for tech careers, basically building that AI talent pipeline everyone needs right now. And finally, Avride. They're focused on autonomous driving tech. Self-driving cars, delivery robots. It shows Nebius isn't just staying in the cloud, they're diversifying AI into, tangible, real-world stuff.
Interesting. Covering the whole life cycle, from data to talent to applications. But let's talk physical footprint. Where is Nebius actually building all this infrastructure to power this big vision?
Okay, their expansion. It's genuinely aggressive and global. Really speaks to that grow-at-all-costs approach. They have a fully owned data center in Menseli, Finland. Right now, it houses around 14,000 GPUs, but this place has huge potential for expansion. They're targeting 75 megawatts of power. That's massive. And aiming for 60,000 GPUs eventually. Just to give you an idea, at full capacity, that one data center could potentially generate over $1 billion in annual revenue. And it's also remarkably energy efficient. It ranks in the top 5% globally for energy-efficient supercomputers. Uses about 20% less power than average servers. That's a pretty compelling ESG point.
Energy efficiency sounds good, yeah. But in a market so obsessed with speed and scale, how much does that ESG angle actually matter to their customers?
Yeah. Well, it's definitely a differentiator. Look, raw performance is still king, no doubt. But for large enterprises, the ones looking at long-term sustainability, operational costs, 10 to 20% power saving, it adds up. Big time. It makes that Finland data center very attractive. And beyond Finland, they're moving fast. There's an Equinix data center in Paris using H200s. They're building in Kansas City, Missouri, a 5 MW H200 cluster there. And Vineland, New Jersey. planning an astonishing 300 mW capacity, plus deployments in the UK and Israel. Overall, they see total capacity going from 30 mW in 2024 to nearly 100 mW in 2025. Plans to exceed 250 mW medium term. It's just rapid scaling.
Okay, now the numbers. Here's where it gets maybe a bit confusing. If you just glance at Nebius's financials, you see this seeming contradiction. How do we make sense of their reported revenue? Seems like two different stories.
Yeah, you've hit on a really crucial point. It can definitely confuse investors. You might look at Q1 2025 and see like a negative 94.71% decline year over year, but then the company itself talks about a 385% increase year over year in its core AI infrastructure business for that same period. It's not really a contradiction when you get the context. The big drop. That's comparing the new, smaller Nebius Group to the huge pre-divestment Yandex N.V from last year, the triple-digit growth figures like that 385%. That accurately reflects the newly focused Nebius Group's performance. Remember, they only started operating independently in July 2024.
Right. So it's apples to apples for the new entity. That makes sense. Can you give us just a quick historical snapshot? The revenue figures charting this transition.
Sure. So Yandex N.V. back in 2022, revenue was about $7.4 billion. Big number. Post-divestment, Nebius Group's revenue was $117.5 million in 2024. That represents a 462.2% increase from 2023 for this new, smaller entity, and for Q4 2024 specifically, $37.9 million revenue. With their core AI infrastructure business growing an incredible 602% year over year, those are the growth rates for the dedicated AI compute part of the business.
Wow, okay. Those are impressive growth numbers for the new business, definitely. So beyond looking back, what does the road ahead look like, especially on projected revenue? Let's talk forward-looking metrics, specifically annualized run rate revenue, ARR.
Right, the ARR figures, they really highlight just how aggressive this growth trajectory is. Nebius hit $249 million in ARR in Q1 2025. That's basically a snapshot, projecting current revenue out for a year. That figure was a 684% increase. Then it climbed again to $310 million in April. Management has set a really ambitious target, $750 million to $1 billion in ARR by the end of 2025. And their forecast for total revenue for the full year 2025 is somewhere between $500 million and $700 million. They are absolutely betting big on grabbing market share quickly.
That's definitely aggressive. Now, profitability. Often the sticking point for these high-growth companies. How's Nebius doing on the bottom line?
Yeah.
And what's the outlook there?
Well, yeah, currently operating at a loss, which is honestly completely typical for companies like this. High growth, capital-intensive industries investing heavily. For Q1 2025, net income was negative $113.6 million. EBITDA, that's earnings before interest, taxes, depreciation, amortization, was negative $110 million. Their adjusted EBITDA loss was $62.6 million. Now, crucially, management does anticipate adjusted EBITDA turning positive sometime in the second half of 2025. However, analyst forecasts, they suggest the company will stay unprofitable on a net income and EPS basis for the next 3 years. We're seeing like an EPS loss forecast of around negative $1.80 for 2025. And that's mainly because of huge depreciation and interest expenses from building all this infrastructure. It really is that classic grow-at-all-costs strategy, a strategic land grab in a new, maybe winner-take-all market.
So they're building the roads into the AI gold rush, not just selling picks and shovels. Sounds expensive. How are they funding all this, especially while losing money? Let's look at the balance sheet health.
Yeah, the balance sheet is actually remarkably strong right now. As of Q1 2025, they had strong liquidity, $1.45 billion in cash and short-term investments, and they boast this current ratio of 18.0, which is excellent for short-term liquidity, basically 18 times more current assets than liabilities. To fuel the expansion, they raised $700 million, oversubscribed funding round back in December 2024, and just announced a private placement of $1 billion in convertible notes in June 2025. This funding is absolutely vital. Their capital expenditures were over $800 million for 2024. And this kind of spending leads to negative free cash flow, or FCF. It was negative $561 million for 2024 and the last 12 months. But again, totally consistent with a company in hyper-expansion mode needing massive upfront investment.
Okay, so burning cash but raising a lot of capital. What does this all mean for valuation? How's the market reading this picture?
The market is clearly valuing Nebius as a pure-play growth stock. Almost like a proxy for AI infrastructure itself. Its PE ratio is negative, around managed to 51.7 as of mid-July 2025, because, well, they aren't profitable yet. This tells you investors are betting on massive future growth, not current earnings. Their price to sales, PS ratio, is extremely high, somewhere between 83 and 108, way above the industry average of about 34. That suggests the market's putting a huge premium on their explosive revenue growth, forecasted around 45% per year. Price to book is about 4, indicating confidence in intangible assets, future earnings potential. Market cap is hovering around $12.4 to $12.6 billion. So yeah, the valuation fits a company prioritizing future growth and market share over profit today. They're betting big on the future of AI compute.
That high PS really underscores the market's bullishness, yeah.
Yeah.
But it also screams high risk. So what does the competitive landscape look like? Who are they actually up against in this AI cloud infrastructure race?
Oh, it's a rapidly growing market projected to explode. From maybe $90 billion in 2025 to over $360 billion by 2030. Huge numbers. Nebius faces serious competition. Directly, you've got CoreWeave. They're a larger, more established, pure-play AI cloud provider. Market cap around $68 billion. CoreWeave seems focused on dominating the U.S. market, projecting maybe $5 billion in revenue for 2025. Then, of course, you have the hyperscalers, AWS, Azure, Google Cloud. Formidable doesn't even begin to cover it. Massive resources, existing customers, broad offerings. I mean, Microsoft's Azure AI reportedly hit a $13 billion annual run rate already. And then there are smaller, more specialized AML platforms, too. Lots of players.
Right. Against those giants, how does Nebius even plan to carve out its space? What's their angle, their differentiation strategy?
Their core strategy seems to be speed and aggressive international expansion. They're aiming to capture underserved or emerging AI compute markets, mainly outside the U.S., which strategically helps them avoid going head-to-head directly with CoreWeave or the hyperscalers where they're strongest. The opportunity for them is still massive. AI infrastructure spending alone is projected near $225 billion by 2028. And there's this important shift happening, too, from AI model training towards inference. Inference is expected to be like 2/3 of AI spending soon. Nebius seems well-positioned for that shift.
Okay, let's zoom back in on something critical you mentioned, that relationship with NVIDIA. Seems like a real linchpin for their whole strategy. How deep does that partnership actually go?
Oh, it's absolutely fundamental. Strategic doesn't quite capture it. It underpins their value proposition. Nebius's core AI platform is explicitly, quote, built on the NVIDIA accelerated computing platform. They're actively deploying NVIDIA's top-tier GPUs, the H100s, H200s, across their data centers. And we mentioned that crucial early access to Blackwell, planning over 22,000 Blackwell GPUs in the US and Finland in 2025. But here's the kicker. NVIDIA Corp itself holds a minority stake. 0.5% in Nebius Group. And NVIDIA was a high-profile investor in that $700 million funding round Nebius did.
NVIDIA doesn't just throw money around like that. That's a serious endorsement. But does that deep partnership maybe create a risk, like vendor lock-in? Does it limit their flexibility with other hardware down the line?
That's a very fair point. And yes, it absolutely creates a strong dependency. But look, in a world right now where GPU supply dictates who wins and loses in AI infrastructure, NVIDIA's stake isn't just an investment. It's like a strategic lock on critical, scarce resources for Nebius. It arguably de-risks their growth path in a way few competitors can match right now.
It's symbiotic, right? NVIDIA gets rapid deployment for their GPUs, expands market reach. Nebius secures access to the hottest, most in-demand GPUs, huge competitive advantage against supply chain issues. So yeah, this partnership is central. Helps attract customers, boosts tech agility, fuels that stunning pace of growth, and validates their whole strategy to investors. It's key.
Okay. But every growth story, especially one this fast, has risks. What are the main ones facing Nebius Group as they chase this expansion, especially being relatively new as an independent company? Oh, there are several significant ones for sure. First, obviously, is the continued unprofitability and high capital burn. Big net losses, negative free cash flow, requires massive ongoing investment, which leads straight to financing and dilution risk. They rely on external funding. That could mean more equity dilution for current shareholders or taking on more debt. Then there's the intense competition we talked about, hyperscalers, CoreWeave. These are well-funded, tough competitors. Market volatility and GPU supply chain issues remain a risk for everyone, even with the NVIDIA tie-up. Geopolitics, export controls, that kind of thing. There's also inherent integration and execution risk. Expanding globally this fast, deploying new tech. Things can go wrong. And finally, yes, they're young, independent operating history. They're still proving themselves, building that standalone track record after the Yandex split.
Right. Lots to keep an eye on there. But for every risk, there are opportunities. That's what makes this so compelling for investors willing to take that on. What are the key upsides, the big opportunities?
Absolutely. The biggest one, hands down, is the explosive AI infrastructure market growth. We're talking a market potentially hitting $363 billion by 2030. The overall AI market may be $1 trillion by 2031. Just huge potential. Their strategic first-mover advantages in certain international markets through that aggressive expansion could let them grab significant share early on. They also have that strong balance sheet for expansion with $1.45 billion in cash, that great current ratio, gives them the firepower they need. The strategic NVIDIA partnership is a massive advantage technologically and for supply. They benefit from that experience management and technical team inherited from Yandex. Strong leadership, deep expertise. The ESG appeal from the efficient finished data center is a plus, increasingly important for large clients. And finally, that strategic diversification through Toloka, TripleTen, Avride, it adds potential future revenue streams beyond just core cloud.
Okay, so weighing those risks and opportunities, what's the general feeling out there? What's the market sentiment, the analyst consensus on Nebius? Future Titan, or maybe a speculative gamble?
Well, the sentiment among analysts is largely positive, interestingly enough, despite the current losses and that high valuation. The average one-year price target seems to be somewhere between, say, $63.40 and $67, with an overall buy rating generally. Goldman Sachs, for example, has them as a buy with a 68-day target. This optimism really stems from, I think, their strategic positioning, that explosive revenue growth, 385% year over year in Q1 25, the sheer size of the addressable market, the NVIDIA relationship, and that expectation of hitting positive adjusted EBITDA later this year. It's basically a vote of confidence in the long-term vision, recognizing they're playing for market share in a foundational, rapidly expanding industry.
So let's try and bring it all together then. Nebius Group, NBIS, it looks like a really compelling, maybe high risk, but direct investment opportunity. Right in the foundational layer of this AI revolution. Its unique start, that inherited tech skill, the critical NVIDIA link, they really set it apart. Certainly an audacious story.
That sums it up pretty well. Look, success for Nebius, it really hinges on deploying that capital efficiently, getting to operational profitability eventually, and navigating that fierce competition. What's really interesting is how their global expansion strategy, which kind of grew out of past geopolitical issues, now actually acts as a deliberate risk mitigation. They're aiming for a more resilient, geographically spread business. It truly is a story of just aggressive growth in a booming industry, placing huge bets on the future of AI.
So given that grow-at-all-costs approach and the market clearly expecting this stunning pace of growth, here's a final thought for you to ponder. What aspect of Nebius's future story? Will it be their technological breakthroughs, their global reach, or finally achieving profitability? What do you think will ultimately be the most defining measure of their success? Thanks for diving deep with us today.